Welcome, ladies and gentlemen. Speaking in the spotlight today, we have Daniel Lacalle with us. I'm very excited to ask him some questions about the market and his background. So we'll kick things off as we usually do. So Daniel, tell us a little bit about how you got into financial markets and your background.
Yes, thank you so much, by the way. Thanks for having me. The reason why I started in financial markets was because in my first job, which was in an energy company, what I started in was actually trading and money markets. And I found it fascinating. I really enjoyed it. And then I developed a career within that energy company in exports, Middle East and Africa, lots of things that were very interesting. And then I went to the area of external relations and the presidency of the company, where I started to have quite a lot of contact with large investors. And that's what made me more interested, even more in financial markets. So when I received an offer to go to London and work in the city in an investment bank, I didn't doubt, despite having a successful career already.
Okay, great. That's an interesting background that you got there, especially with the export things that you mentioned. Daniel, given your knowledge and your experience in financial markets, in your opinion, what's a typical pitfall that a lot of traders or investors can make that, in your opinion, is something that they should be mindful of and able to avoid?
I would say that one of the biggest mistakes we all make is to try to second guess the central bank. Is to, for example, right now we're living in a moment in which everybody knows that central banks are talking about rate hikes, yet you have an incredible amount of talent that is wasted trying to second guess whether they will U-turn, whether they will not do what they say that they will do, etc. I think that is a big mistake, because the idea that central banks will act quickly in order to save you as an investor from mistakes is very dangerous, because they can take a long time to make those policy changes. The second is actually on the political side, and we all remember, for example, in the European crisis 2011, when many investors expected everything to be solved by the European Union in the next summit. Remember that there's going to be a summit in March, and then there's going to be a summit in June, and to see those as catalysts, because usually politicians' timing, and logically, has had absolutely nothing to do with the timing and the tolerance for volatility of investors.
Well, Daniel, thanks for that. And I think, that'll be really useful to traders, because, as you said, they do sometimes second guess the central bank. And that's, I guess, where that phrase comes from, don't fight the Fed. Speaking of central banks, Daniel, one thing that I've been mulling over in my mind at the moment is this question, are central banks making a policy mistake? Have they got their blinkers on with inflation too much? And potentially, is that 2% target outdated now that we're living in a post-COVID and post-war environment?
I think that central banks are doing what they have to do. However, what they're doing is very slowly, because yes, I think that they have adjusted their inflation targets a little bit in the last couple of years. However, the levels of inflation that we're living in developed economies are truly negative, because we need to understand that in a developed economy, we have very strong deflationary forces, technology, demographics, obviously the fact that the value-added industries account for a larger percentage of the economy than in emerging economies. So those are, let's say, elements that should keep prices relatively stable. However, if the Eurozone has a 7% inflation and the United States has an 8% inflation, included and embedded in those factors, then it shows that the situation is significantly more negative than what central banks envisioned, and certainly what their policy and their targets indicate. So I think that they have to hike rates, and that they have to do what they have said that they will do. And more importantly, what they need certainly to do is to reduce the quantity of money in the system by reducing the asset purchases. Obviously, that is painful for a short period of time for investors. Absolutely it is, but it's good for the economy, and therefore it is good for investors in the long term.
Okay, great. Lovely view on that, Daniel. Insightful. And then just to finish off with, the other question I wanted to ask you was related to, so we've seen the equity market, it had made 7 consecutive weekly declines. Record numbers actually, only twice has it done it for 8 weeks, but it looks like this week we're not going to see the 8th weekly decline. Do you think this turnaround has legs? Do you think it's a short squeeze and it's temporary, or do you think this is actually the beginning of a change and turning of the corner, so to speak?
We need to pay attention to volumes in order to understand whether this bounce is a bear market rally. Bear market rallies are vicious because people get excited about a bounce, and then stocks and bonds start to collapse yet again. Then the ability to buy in on the dip is very, very limited, and most investors end up capitulating. No? So I think that at least now it is good to see a consensus view that this could be a bear market rally, and that therefore it is important to be prudent, to look at it in a way in which it doesn't consume the amount of capital we may have left behind in order to look for new investment opportunities as prices get better and valuations get more attractive. But we don't know yet, because bear market rallies are very complicated to predict. The best way to predict a bear market rally is to wait for a month and see whether it has legs. And as a very good friend of mine used to say, the first 10% is for the heroes and the last 10% is for the reckless. So I think that being prudent is advisable, yes.
Okay, fantastic. Daniel, thank you so much for joining us and giving us those insights, your background and tips and tricks for traders to avoid, and those market insights there. And I really look forward to the full presentation of Pepperstone's talks on Wednesday, the 8th of June.
Same here. Looking forward to it. Thank you very much.